Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, a lot of investors think that they've got their asset allocation figured out, a perfect mix of equity and debt. But there's a catch there because studies show that a lot of investors are still doing it wrong. So, are you one of them? We'll talk about that and more with Dhirendra Kumar today. Welcome, Dhirendra.
Thank you.
So first up, why is asset allocation important? Why is it a big deal for long-term investors especially?
For long-term investors, it's very important because if they really don't care about asset allocation, they will not be a long-term investor. They will be scared out of the market. What asset allocation does is that it prevents you from, when you have the steep fall in the market, it helps you navigate that phase better. It helps you participate in the growth well. It's almost like buying insurance. Because if all your money is in equity and when you see a massive decline, and equity markets by its very design will see a massive decline, it becomes very difficult, and more so in your first big decline or the second big decline. Maybe not the first one, because you might see the first decline soon after you start investing, which means that you don't have much of an accumulation. But by the, if you have been investing for 4 or 5 years, you haven't seen a big decline, and then you see a big decline, and that decline could be 20%, 30%. And before that decline, you have started weaving, all your dreams. That you started with 10,000, then you increased it, and then you accumulated it, and now it is 13 lakh. And now you're thinking that, okay, things are getting sorted, and things are everything you should be very happy about. And then you see that 13 falling down to 8 lakh rupees, 6 lakh rupees. It gets very difficult for investors to withstand that. And if you don't do asset allocation, you will not be able to de-risk yourself. And if you don't do asset allocation in that fall, you will not be able to benefit from that fall. So it is not just important. I think it will save you, it will prevent you from benefiting from the market, the beautiful thing that has been devised, which is a market, and gaining access to a diversified set of productive asset, inflation beating assets.
Okay, so for someone who's investing for long term, say 20 years and more, how should he look at equity versus debt?
Someone investing for 20 years should actually be heavily invested into equity to begin with, and once it becomes something meaningful, then you should have for 20 years, so after 5 years, assuming that you have something meaningful, then make sure that you have 10-20% into fixed income. As you get closer to your goal, or as you have less time for your investments to stay put, that is the time when you should start increasing your fixed income allocation and begin reducing your equity allocation. But and assuming that even on your retirement or 3 years after retirement, you have done no asset allocation. I would say that in the worst of case, if it is a long-term money, you are unlikely to consume all that money at one go. It is not meant for spending. Then also investors should have ideally 50%, 60% into equity. Simply because that is the way your money will be able to protect its value while you are also consuming a good part of the gains that you are generating.
So when it comes to fixed income allocation, how should one look at debt funds? Can they also be risky?
Debt funds, even though they may be risky, the scale of fall will be nominal. And you never see that 30%, 40% decline in 2 months' time. That's one. Besides that, you can actually limit your exposure to a certain kind of debt fund, because when you are investing your money in fixed income, the debt fund per se, for reducing your risk, your options are very limited. You should invest in a short-term debt fund or a liquid fund or a ultra short-term bond fund, simply because you are not putting your money in fixed income to maximize return. You are only optimizing return, keeping the money at work, stabilizing. Your goal is different. And then there is another way of looking at it. Most investors also have a public provident fund account, or there could be employee provident fund account. There could be some mandatory fixed income, fixed deposit or something, or there could be something essential needed for your bank account, or NPS. All those things. So you should look at your fixed income allocation holistically. And It is complicated because all these things are managed at different places. But at Value Research Online, you can aggregate all of it. Your equity funds, your fixed income fund, your equity portfolio, your NPS, your PPF, your EPF balances. If you put it all together, you will get a 360-degree view of where your money is lying. And based on that, then you decide that whether you want your 60% money into equity, 75% into. For that, you don't necessarily need to rejig over your whole portfolio. You can do it with something on the balance. With your, maybe if the portfolio is, something like 20 lakh rupees, all of it put together, then with 2 lakh rupees, you can actually swing the whole thing. All you need is a holistic view of your overall portfolio, and on the margins, you can rebalance it.
Right. So should investors stick to a fixed equity debt ratio, or should they be rebalancing it periodically? And if rebalancing, then what should be the frequency?
Yeah, it's very difficult to quantify your risk tolerance simply because, it is a function of how close you are to your goal. When are you likely to need the money? How critical is that money? Assuming that both of us have 10 lakh rupees invested, but that 10 lakh rupee, I need it for some very important goal, for somebody's treatment 3 months down the line. And that your 10 lakh rupee is meant for your
Holiday abroad.
For holiday abroad. I might not be risk averse, but my requirement, my necessity is actually altering. Non-negotiable. And the urgency of it. So, or the critical dependence on that. So, you have to really think that how much can you really lose. As I said, that there isn't a formula. You have to broadly, sense it. And I would say that in plain English, I would like to quantify as, or I would like to state as, substantially equity, or substantially fixed income, or reasonably balanced. Now, balanced is 50% equity, 50% debt. And my rebalancing triggers will be that if that changes by 5% or 10%, like my 50% into equity, 50% into debt, and it changes and it becomes 55%, I will rebalance. Substantially equity, I can well keep it 65% into equity, or it could be 75% into equity. Broadly, it will give me the same experience. I will be just as upset or disappointed based on 65% or 75% will mean the same thing. Likewise, substantially fixed income, that is again 65 or 75, it won't make much of a difference. But I will not be running for cover if I have done it to best of my ability, best of my own assessment.
So from your years of experience in mutual fund industry, you must have interacted with a lot of investors. What do you think are some of the most common mistakes that investors tend to make when it comes to asset allocation?
One is that the biggest mistake they do is that they don't do an asset allocation. And even if they have done an asset allocation, they never rebalance. So I would say that nobody has got it right, and somebody is to be blamed for it, which is, I think, we need tools, we need triggers, we need information, and it's very complicated. Also, it is a very difficult thing to do, because if you have to move your money from equity to fixed income in a rising market, and you have to do it in a rising market, because only in a rising market it will go up, we tend to get greedy. We think that, no, it will keep going up. We get optimistic, and investing is an optimistic exercise. So it requires some degree of, information, some degree of belief.
Also, I think taxation of debt funds, isn't that a deterrent to rebalance, because it's a huge percentage of your money?
It is of late, but there are ways to configure it. If you actually build your portfolio with 30% into hybrid funds, then it can be done very differently.
You don't do it yourself, but you assign it to a fund manager.
You assign it, and if that is substantially, so they will be rebalancing it at their own level. But at the same time, to protect your capital from something which will alter your whole approach to investing, it is very important to be prepared to pay taxes than assume a set of risk which you will not be prepared for, or you will not be able to withstand. So it is very important to ignore the tax and guard your money in a manner that it will help you, be there.
So to sum it all up, what would be one key takeaway that you would want investors to take from this discussion?
Earn, save, invest, and after 5 years, think of an asset allocation. Monitor all your investments at Value Research Online so that you get your asset allocation very precisely, and it can be done with great ease. With a single click, your PAN number and all your investments can be imported. Once you do this, a 10% drift from your stated asset allocation, whether it be 90% equity, 75% equity, 50% equity, or 25% equity, a 10%, 20% drift from there, rebalance it. Or take a look at it every year and rebalance. And if the required rebalancing is less than 10%, don't rebalance it. You will save the taxes.
I'm sure a lot of investors would be interested in knowing what is your asset allocation like.
I'm actually a little embarrassed to say that I'm 100% into equity. And I'm 100% into equity for a different reason. I live in a joint family with my parents, and my parents have a good amount of money in their fixed income. And I'm still working and I get my salary every month. And I'm reasonably assured that I'm unlikely to lose my job and I'll continue getting my money. Don't emulate my asset allocation simply because, I'm way too experienced, 35 years, and I have seen 3-4 market cycles where I have witnessed 75%, 65% decline in value. 20 years back, I used to get scared. And I'm telling you this from my experience. Because I have experienced that, and now my equity portfolio or my mutual equity fund portfolio, I understand it so well that also reduces my risk. I will not panic, because why you need to do asset allocation? So that you don't panic at the wrong time. And because I'm confident that I will not panic at the wrong time, I think, I'm justifying myself to be fully invested in equity. But I regret that, and I think I should have a little bit of fixed income for a very special reason. Once in a while, you get an opportunity or that the market tumbles, and sometimes it tumbles without a reason. It tumbles simply because it was going up, so it goes down. And if I want to capitalize on that opportunity, I won't have that money. So with that in mind, I think, after this conversation, I'll think in terms of how to create some fixed income allocation, maybe 10%, maybe 15%, but so that I have the satisfaction of, investing in equity if it, when it crumbles. So I'm entirely into equity, and for my own context, and I think I'm a very lucky one to have that context, which is enabling me to be fully invested in equity.
All right, so hope today's discussion will help you decide the right asset allocation mix for yourself. Now, moving on to the viewer's question. A very wealthy investor has sent in this question. He says he has received 1 crore rupees as inheritance. He already has 3 crores in the stock market, 1 crore in mutual funds, investments in PPF, PM Vaya Vandana Yojana, Senior Citizen Saving Scheme. He's 70 years old and receives 50,000 monthly from the above investments. He'd like to earn an additional 50,000 rupees from his inheritance for the next 20 years. So he wants to know how to rebalance this entire portfolio or just concentrate on the new inheritance.
No, he should just focus on the new inheritance. All he should do with his older investments is that he should make sure that they are of reasonable quality. They are decent investment. They are decent long-term investment. They are not too expensive. They have done better than their peers. These are the yardstick on which to measure. But I think, for earning additional 50,000 rupees from his new 1 crore rupee that he has inherited, he should do a very simple thing. Invest in 1 or 2 aggressive hybrid fund and not at one go. Spread it over next 6 months or 9 months or 12 months. Amount of 50,000 rupee SWP, if he's investing in 2 funds, set up a 25,000 rupee SWP from both the funds. I'll explain you the rationale for this. This withdrawal of 50,000 rupees on a capital of 1 crore is 6%. And I'm very confident that this investment will generate more than 6%. But the problem is that this 6% will not be very consistent. There will be some years in which he will lose 6%. Some years it will go up by 20%. Some years it will go up by 10%. I'm generally thinking that, if he earns 12% every year on his investment over a long period of time, which will be few years very high, few years very low, he will actually be consuming only half of the return. The half that he will not take out will actually lead to greater capital, larger capital, which can supplement higher income in future. Because today it is 6% of 1 crore. Tomorrow, if he needs 10% more 3 years from now, which will be 55,000 rupees. For that, he needs a larger amount, of which 6% will translate into 55,000 rupees every month. So for that, it must keep growing. So aggressive hybrid fund, not more than 50,000 rupees withdrawal, revise it every 3 years.
All right. Well, thank you, Dhirendra.
Thank you.
Well, that's all we have for you in this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.